I am under the impression, like lease accounting, I even give my whole team saying, we are going to talk to the auditor about this. I'm not touching it because it is way too complicated. I don't even want to deal with it.
I got nothing. I love complicated stuff, dude. It's like it's the moat around your practice that no one else is going to come and try and steal your clients.
Yeah, but like your clients don't get audited either, though. So like even if we did it and didn't do it perfect, somebody else is doing it anyway.
Have you seen how shady I am? All my clients get audited.
What if the time-consuming parts of accounting just handled themselves? That's the idea behind Stack by Ramp, an AI-native platform that lets you deploy agents to do the repetitive work. Reconciliations, journal entries, flux analysis, your processes, your rules, your clients. You decide where it runs on its own and where it stops for your review. We personally at Specialized Accounting tested this out on a couple of our clients while it was in beta and saved over 50% of our monthly time on certain bookkeeping clients. And they've got the data to prove it. Ramp evaluated Stack against 200 plus real accounting tasks built and graded by working accountants, yours truly included, and it outpaces the general purpose models. So start your free 3-month trial at ramp.com/unaccountable.
Welcome to Unaccountable, the world's okayest accounting game show podcast for product news, updates, and education. I am your Hornet in training of a host, Tyler Otto, and I'm joined by the potential Panther, Jeremy Van Groll. And
nope, you don't even get to go any further. How many weeks has it been since we got to record together?
Right? I think we're at like 6 weeks or something like that, because we do every other week, and I was gone, you were gone. Yeah.
And I just had to throw that in there because you had to throw shade that Beth and I didn't get to a question or a game until like 30 or 40 minutes into the episode. So I think I just started the first question, the earliest ever that we have had on the show, just in retribution.
I mean, if we want to get technical, when I ask, how are you doing every episode, isn't that a question?
Fine. You always got to try to one-up me. What the hell, man? Let me take a win.
That's what I'm here for. I did not understand your intros you wrote here until you had to explain them to me. But, I mean, Hornets, Panthers.
Yeah, where are we headed?
We're heading to Charlotte next week, man.
Yeah, second time this year for me after I've never been there before.
I know. I'm excited. And we're going to, hang out with the entire Bridging the Gap crew, Randy's conference, Tony's hometown. Unfortunately, we're talking about something that by the time this aired, we're flying home from.
Oh, yeah, exactly. But next episode, we'll give you the whole overview, how things went, what maybe didn't. We have some sweet jackets for the one evening plan. Oh, man, it's going to be awesome.
It's going to be great. Jeremy, into news this week, I had one article I wanted to bring back because, I don't know, maybe this is hope for us. It depends how you feel about the IRS in general, which I think we all have a love-hate relationship, right? Because, it's the reason we have a job sometimes. Because if they didn't exist, no one would hire us. But also, we get annoyed with them. But an arbitrator for a case that, ever since President Trump signed that everyone has to terminate their remote work and get back in the office, for the IRS, the arbiter ruled that remote work is back for some IRS employees. Which for me means some people that maybe don't have childcare or other things that couldn't come back to the office. Maybe this means more people answering the phones. Maybe this means better service. I don't know.
One could hope, right? I mean, in our last UFAT, I quipped about this as can we get a little more people on staff to answer the phone and answer questions and all that? Yeah. Ugh.
Speaking of UFAT, this is not on the notes we have here, but folks, if you have not yet, come play with us every Friday. This is airing on the 30th. The next UFAT, Unaccountable's Fortnightly Accounting Trivia, Friday afternoon, noon Mountain. And I mean, what Ramp gave away an Aura ring as the grand prize. People are giving out $50, $30 gift cards. Come answer shenanigan trivia and win some prizes.
Yeah, absolutely. And it's fun. If I do say so myself.
Yeah, that too.
Yeah.
Jeremy, also in the news, did you see what I put on the agenda?
No, I did not prepare well, as usual.
I have a story for you.
Okay. Ooh, I like story time.
Something new happened, right?
Okay.
You, me, our friends, we always complain in our video chats together about what's going on in the firm, and nothing's new under the sun, right? Employee issues, client issues, tax issues. Like we're retouting the same thing. I have a novel new client issue that I think we all saw coming, but I haven't heard anyone experiencing this before.
Okay.
We onboarded a client today.
Okay.
And jury's still out if it's good, and maybe it's bad of me talking about this on a podcast, but I'm not saying good or bad. But we asked them what point of sale they're using. In the hotel industry, we call these PMSs, property management systems.
Mm-hmm.
This client proceeded to tell us that they are building their own. They are using Claude code, and they are building their own. And some of you might be like, oh, cool, cash in, cash out, how hard can it be? The accounting industry has advanced deposits, deferred revenue, multiple types of taxes that can vary by city, county, state, province. You have international payment requirements, GDPR, PCI compliance. California has their own rules on accepting payments, trust accounting rules. You got Airbnb and Expedia that collect the taxes on some of them and not on the others. You got to map to it. I'm at this spot where I finally have a client saying they're going to DIY it on their point of sale. Would you be excited or terrified?
Oh God, terrified. Because first of all, like I liked the flex with how many acronyms you just threw out there with all the things that the hotel industry has to deal with, but yeah, like they don't know any of these things, and do they even know accounting to like know what they don't know?
Here's what I don't know enough to know if they don't know what they don't know.
Yeah,
I wasn't on this onboarding. I've only seen part of the recording. Who knows? I might be surprised. Like these guys may be like, oh yeah, we're working with this web app development team. We've got it all built. We've been working with this compliance group. Maybe they do. I don't know. But my gut reaction was terrified that we're basically going to get reports that don't tie out to standards and get asked every month, what do we need to do to fix it?
Yeah. But should we be prepared for this? Because like that's what everybody's saying is like AI can build these things for you just like something like that or what else. And it's funny you bring this up because I had a client yesterday or Monday or something tell me that they hate Expensify and they're just going to build something internally for their expense management. And I was like, no, Ram, for the love of God. I don't know how many times I got to tell you, go to Ram.
I mean, yes, like we know this is coming. Like back in the day, Jeremy, right? Clients could be like, hey, do I want an expense management system or do I want to track it in a Google Sheet? And you know what? Sometimes small enough businesses, a Google Sheet's fine. And maybe we're getting into this world where, hey, you want to build something small and with AI yourself, great. But if you want to try and compete, like, don't think that you can build something better than Expensify, because it's not you and AI versus Expensify. It's you and AI versus Expensify and AI. They're using those tools better, and they have the knowledge to use the AI better than you do. So, and then, again, like if it's an expense management system, great. If you're dealing with customer level data, the names of their kids, birthdays, credit card information, do you really think you have the skills to know what you don't know?
And protect that better than a organization that has, I'm sure, all sorts of angel investor funding or bonds coming out or whatever. Oh, man. Yeah, I do think you need to keep us apprised on this journey.
I like this client. Nice people, lovely. I actually really like their vibe as like people. Yeah. I'm just worried about this. And again, I don't know what's going to happen. We may go dark on this depending what it is if I don't want to get in trouble. Also this may be a recurring tale. Regardless, Jeremy, you'll know about behind the scenes and people can come ask me at conferences. Yeah. Oh, I love this. Whew. Yeah, glad that wasn't on my bingo card today. I got enough. Well, you've had your own bingo card that we won't get into. Oh man, it's been a week. Cool. With that, let's get into our first game, right? Okay. Inspired by our last UFAT, that was a theme of RevRec or revenue recognition. I thought we should talk about some expense recognition in a game I'm calling Expense the Unexpected. I mean, top-notch name for a game. Like A+ level, Expense the Unexpected. I'm pretty proud of this game overall, so I'm pretty excited about this one. So I got 10 questions for you, who wants to sit for the CPA exam soon. Studying. Scheduled the date, September 17th, first test. Ooh, nice. All right, cool.
We'll make sure that we have a recording or something planned that day. Throw a wrench in it. Okay, so I'm going to give you 10 scenarios on expenses, and then you got to let me know what the right treatment of that expense would be.
Ready to fail.
All right, let's do it. All right, first one. Ripped One Fitness Centers spends $75,000 in December training employees, developing operating procedures, and preparing its first location to open in February. How are those costs generally treated? Is it A, you capitalize them and amortize them? B, capitalize them and until the location becomes profitable? C, expense them as incurred? Or D, record them as organizational optimism?
I'm going to go with A, Jeremy.
I got no.
Wait. Say the answers again. Hold on.
Okay, capitalize them and amortize them. It says over 10 years or whatever year you want to pick, or what's the right thing. I'm not.
Well, there's the 5,000, and then if it's over 50,000, then you have to reduce that 5K dollar for dollar. But yes, go on.
Okay, next one is capitalize them until it's profitable, expense them as incurred, or record them as, or the BS one at the end. So I'm thinking, like, is this an R&D cost?
It's not R&D if you haven't started yet. It's a startup cost.
Startup cost, right? That's what I meant.
Yeah, startup cost. So you can't claim any deductions in startup costs until you start generating income. The moment you generate your first dollar, then you can start expensing, and it's over the 10 to 15, whatever. But you get $5,000 for free, and then you get 50 grand spread out over the remaining period. But like, there's this: if it's over 50 grand, you lose the free $5 for dollar. It's weird. I don't remember the exact math.
So I remember us talking about this before. So if your mom would have gave you $1 when you're helping her in a form for bicep curls, then you would have got that, right?
So I mean, here's the thing. I mean, there's always the IRS step-through doctrine, of like, okay, but what's the material effect? And you record $1, are they going to be like BS versus like, hey, you had a giant party and you hosted like this massive fitness challenge for one day, brought in tons of food vendors, before it was open, and did this whole thing, and you generated substantial income. And then, yeah, now you could start generating income. The $1 thing, you're probably going to have the auditors say there's no economic substance, bull crap, we disallow it. But
all right, fair. Okay. All right. I like it. Let's go to the next one. So Otto Laboratories spends $400,000 attempting to develop a jet-powered stapler.
I believe you have my stapler.
The prototype materials have no future alternative use. The stapler remains highly dangerous and commercially questionable. How should the costs be recognized? A, you expense them as R&D when they're incurred. B, capitalize them until the stapler proves viable. C, capitalize them and then amortize it over the expected life. Or D, expense them when management finally admits it was a bad idea.
Probably D, but I'm going to go with... Again, I'm going with A. You're expensing them, and then you can take the R&D credit later, right?
Yeah. Good call. I think I had the R&D thing in my head when we were talking about the first one after reading through these. But yes, so R&D costs, expense when incurred. There's also some credits out there. I don't know anything about that, so I'm not going to go there.
It has to be, it has to pass the 4-part test to get the R&D tax credits, but yes.
All right, let's go on to number 3. At December 31st, Sue You Later LLC is facing a lawsuit. Its attorneys conclude that a loss is probable and estimate the loss between $100,000 and $400,000. No amount in the range is considered more likely than the other. What should the company accrue? A, nothing until the lawsuit is settled. B, $100,000. C, the midpoint of those two, which, what is that, 250? I don't know, 250, something like that. D, the full $400,000.
Okay, so it's either C or D. I am confident of that. You absolutely accrue for the estimate, because this was literally in the sections I was just going through in Becker for studying. My assumption is you do the midpoint. You do the reasonable estimate, but I wouldn't be surprised if you found something saying it should be 400.
I'm getting it should be the lowest one, B.
What?
So, again, this is why I don't want to...
Conservative?
So, again, not thoroughly researched, so these things are all arguable, but GAAP generally requires the accrual of the minimum amount in the range with the disclosure of the additional possible exposure.
Interesting.
You don't agree with that one?
I mean, GAAP has all these weird rules, dude, of what they require, and how you fair market value. Like, dude, all I've been learning so much is there's always a different reason. But, you know, every study material I've been going through lately says the most reasonable. So it doesn't say like, oh, you have a range, you pick. It's kind of like you look at it and you say, what's the defensible reasonable? Well, if you come to it and say, hey, we think it could be 100 or 4, reasonably, we think probably 250 is where we're going to land. If all it takes is one lawyer to say that's probably where we're going to land, and that's your number.
Right. Yep. No, I'll totally agree with that. All right. Number 4, Smoothie It Over LLC sells $2 million of blenders during December. Each blender has a standard 1-year assurance warranty. Historical experience indicates warranty claims will cost 3% of sales. When should the expected warranty cost be recognized? A, when the customers submit claims. B, when the company pays the repair shops. C, at the time the blenders are sold. Or D, when the first blender starts sounding like a 747.
Your D answers are fantastic today. I think under GAAP, you are allowed to start expensing if it's a consistent amount of 3% at the time of sale.
Correct. We're gonna agree on this one. So why, like, a standard assurance warranty relates to the product sold during the period. So the expected warranty expense and liability should be recognized when the related sales occur rather than when claims come in.
In hospitality, we're allowed to expense allowance for bad debt if we have a historical trailing average showing that, yeah, we don't collect on 2%. We can expense 2% in the period and let it sit on the balance sheet to offset bad debt coming out.
And not even only can, should, right? Like that's... Yeah, I think that's standard. We get that with like grants receivable all the time. That what is that range, and auditors will adjust that and stuff. Yeah. Cool. All right. Number 5, IRS BFF Inc. carries fax machine accessories at the cost of $80,000. At year end, their estimated selling price, less completion and selling costs, is only $60,000. And the company uses FIFO. What should it do? Keep the inventory at the $80K until it's sold. Record a $20K loss in the current period. C, record the loss if only the company permanently closes. Or D, rebrand as Vintage Technology and add a markup.
Obviously D. Does this get into that whole, like, you have the different types of the 4 main financial statements, and there's that below net income where then you record gains and losses of unrealized? Is that where we're getting here?
I don't think so, but you can make an argument.
On standard net income statements, no, you do not recognize the loss. But if you're doing that other one that I should probably remember from studying, the 4th one that includes unrealized gains and loss down below, yes, you recognize it there.
Okay, so I'm saying it should record a loss here, but I know what you're saying. Like, my accounting theory classes are rolling around up there when you're saying it, so I don't care with that one. But typically inventory, using FIFO, you would use the cost as either the lower of cost or net realizable value. So I think this one's making the argument that net realized value of this inventory is only $60K, not the $80K, so you should write the loss down.
All right.
Okay,
I'll roll with it.
All right.
Inventory is hard because if it's an asset, an investment, a painting, something else, you don't recognize it in standard net income. But you're right, net income is operating. That gets treated differently.
Yep, agreed. Okay. All right, number 6, Free Range Ferret Farms signs a 3-year operating lease. The first 3 months require no rent, followed by equal monthly payments for the remainder of the lease. How is the lease expense generally recognized? A, no expense during the first 3 months. B, expense the cash payments only when made. C, recognize a generally straight line single lease expense over the term. Or D, expense rent based on the ferret population at each month end.
Your D's are fantastic. I'm going to go, I am not confident on this one because we see this all the time with insurance at hotels where it's like, oh, we're just going to spread the yearly amount over 10 months, right? Like they make you do 10 payments for 12. And like you don't pay for the first month or the last month. But I still think you're flatlining that over 12.
Correct. C is that you should take the full cost and spread it out if it is an operating lease. I am under the impression, like lease accounting, I even give my whole team saying, we are going to talk to the auditor about this. I'm not touching it because it is way too complicated. I don't even want to deal with it.
I got nothing. I love complicated stuff, dude. It's like it's the moat around your practice that no one else is going to come and try and steal your clients.
Yeah, but like your clients don't get audited either, though. So like even if we did it and didn't do it perfect, somebody else is doing it anyway.
Have you seen how shady I am? All my clients get audited. I'm just kidding.
Yeah, right. Moving on.
And that's what gets clipped and put on the internet. My sales tank.
Right?
Have you seen how shady I am? All my clients get audited.
Have you seen how shady I am?
Right?
Editor Ian ruins my career.
I love it. All right, number 7. On December 28th, the board of By Felicia Industries approves a one-time plan to terminate 30 employees and provide each with severance. The plan remains confidential until the employees are notified on January 5th. When is the one-time severance liability generally recognized? Is it December 28th when the board approved the plan? That's A. B, December 31st because management knows it's coming. C, when January 5th when the plan is communicated. Or D, when Brenda updates her LinkedIn profile.
So good. You have not put this much work into one for a while, and I love it.
I did, yeah.
Okay, I'm feeling like it's year 1, not year 2. So I'm gonna write off C. I'm 28th is the board approves it, 31st it's announced.
Yeah.
Like you're not gonna have to make it public to anyone, but when you record it on the financials, I think you're putting it on the 28th.
So again, I'm going to say January 5th. So the logic here is internal approval alone is generally not enough to recognize one-time involuntary termination benefits.
Okay.
The arrangement must meet the applicable recognition criteria and be communicated to the affected employees.
Interesting. Okay.
All right, 3 to go. Former Saurus Quarry Company installs equipment on land under a legally enforceable agreement requiring the company to dismantle the equipment and restore the site once operations end. Okay. The fair value of that future obligation can be reasonably estimated. Okay. What happens when the obligation is incurred? So, A, you record nothing until the equipment is removed. B, you immediately expense the entire expected restoration cost. C, you recognize an asset retirement obligation liability and add a corresponding cost to the related asset. Or D, create a future us problem reserve.
I'll be honest, I got lost halfway through the question and I'm not going to make you repeat it, so I'm going with D.
Yeah. C is this one. So like you need to create an asset retirement obligation liability and add the cost to the asset because of the future liability that you need to do based on the contract that you have to pull the stuff off the land and repair it and all that.
Okay. I'm learning something here.
All right. Yeah, I like that.
What really intrigues me is like, did you know what section I'm sitting for? And like go Google questions for it, because like you're ticking boxes of what I've been studying in the last couple weeks. Some of these.
I'm here to help, Tyler. All right. Keep her moving. On January 1st, clothing manufacturer Vest & Show Inc. grants employees stock options with a grant date fair value of $120,000. Employees must stay with the company 4 years before the options vest. Assume no expected forfeitures, weird complications, any of that. When is the compensation expense generally recognized? So all 120, is it on the grant date? That's A. B, $30,000 per year over the 4-year period. C, when all $120,000 when the options are fully vested. Or D, only when employees exercise the options and purchase matching vests.
I like that.
Mm-hmm.
So I believe you're going to still put them as common stock and have them as options the day that they're issued, which is great. But then you're not going to expense it until they vest. Because what other, like if you're expensing it over the years, where is that offsetting credit going? Just in equity as sitting as a potential liability to someone else? No. So I think you're going to do it at the vest date, but I could be wrong.
No. What I'm saying is share-based compensation is generally recognized over the periods the employees must remain in service. So in this case, you would want to spread that out over the 4-year period.
So you're debiting the employee expense. What are you crediting there? Because you're not giving it to them yet. Is it just a liability to be paid out?
Yeah.
Okay.
All right.
I've never given my employees equity.
No, let's not. I've offered it to one of them. She's like, no, I don't need that kind of.
I don't want to be tied to you.
Great. Yeah. All right. Last one. On December 31st, Sausage Party Rentals owes your company $150,000.
Yeah.
They file for bankruptcy on January 20th, but it's before you have finalized your December 31st financial statements. You have some indication that they had been in serious financial distress during the month of December before you put your statements out there. What do you do as a company?
Because I know there's rules for like private companies, corporate companies, issue date, and distribution date. But it happened before issuing and distribution, right?
Correct. So, yeah, as the end of the year.
And it's associated with last year.
Correct. They owe the receivables open at the end of the year.
If it's associated with last year, you're pushing it into last year.
Correct. So I didn't give you the options.
Oh, sorry.
The D wasn't as good on this one anyway. That's what she said. The bankruptcy. Sorry. But yes, because you knew about this information and you have not finalized your financials, you should be taking that adjustment in the current year as a credit loss, or the prior year as a credit loss.
Yep.
I have no idea how you did, man. Probably 50-60%. We're going to go with that. Nice work.
I'll run with it. You know, Jeremy, that was a solid game. Working my brain. I need a snack. Let me ask you something. You down with MCP? Yeah, you know me. And so is Double. Yes, Double has just released their new MCP, or Model Context Protocol, which for nerds, that's how you connect your favorite AI bot to your platform of Double to be able to triage and instantly transform your experience with your client portal into the most revolutionary task management system. Want summaries of client workflows, open tasks, team performance? You are limited by your own imagination right inside your Claude, ChatGPT, Gemini, or Copilot. So head on over to doublehq.com, give them a try, because this new MCP is going to change the way you run your firm. And better yet, don't use MCPs? Great! They just rolled out Ask Double, your own chatbot with Inside Double to execute tasks, perform work, and make your life simpler. doublehq.com and tell them the guys at Unaccountable sent you. And with that time, we are at halftime. Time for an app snack. And today, we're going to be looking at the company Slash. Jeremy, are you familiar with Slash.com?
He's a guitarist for Guns N' Roses, right?
Oh my gosh, let's get a riff right here, Ian. Jeremy, have you heard of this company before?
I have not.
Tell me if this sounds familiar. A credit card spend management company with approvals and workflows integrating with your accounting software.
Probably 5 to 10 other companies that even I could name off the top of my head.
Let's hear them. Let's hear the competitors.
Oh, God. Bill.com, William,
Yep.
our friends at Ramp.
Yep.
Expensify.
Well, no. Expensify doesn't have the cards. I think they sit on top of other people's cards.
Okay. Does Concur do that as well?
Yeah.
Yeah. Maybe I'm not with
You're
the
looking
cards. Brax is the other one. Yeah.
Yeah. Mercury. They got banking now too. But all that being said, Slash, another one coming up where, yeah, a lot like Divvy used to do, a lot like the other credit card spend companies. This is another player, but I actually know a couple companies that are switching to this, and apparently they like it a lot. It's the same sort of thing where you can get started for free. You can have banking built in. You can have approval workflows for credit cards. You can have outgoing wires synced to your QuickBooks or whatever system and manage it all. I mean, dare I say, I don't know if I can give you like, hey, Jeremy, look at this amazing new software that's shaking up the industry. More so, I'm just surprised at how many options there are.
Yeah.
And definitely one that like, hey, if you're not content with your current provider or for reasons you're looking at something else, one to definitely keep an eye on.
Yeah, yeah. And I did a little bit of research on this and like generally really well reviewed, right? Like 4.8 or 4.7 stars out of 5 at several different places, Trustpilot being one of them. And I did look at it too, does sync with both QBO and Xero. So I'm not sure if some of our friends don't sync with Xero yet. So if you're looking for that option, that's a good thing out there. Cost, again, general, I think it's like if you're not on one of their paid plans, an ACH costs $1, I think, and their pro plan or whatever is $25 a month. And then you have like expediting fees and other things like would come up with any of the other ones. The one other piece I did see on this, it looks like their like bill pay is almost brand new, started in May. So, I mean, hopefully like they vetted it and have some people and it works well, but just relatively new. But yeah, the rest of it, again, looks like definitely another solid option that could be if you're looking for payables management.
Here's what gets me. So first of all, I'm intrigued by this because they show their integrations. And I don't know if you looked at this, but you know, they've got they claim they have a bank feed built in. Now you've worked in Ramp and Divvy and all of those. You have to work within those softwares and then push your transactions over to QuickBooks. These guys are claiming they have a bank feed that works directly in the systems of QuickBooks, Xero, NetSuite, Sage, FreshBooks, and Wave. A very different approach where if you want your credit card spend management company to sync directly into your books rather than having to push them over in a sync to a general ledger. That's the one interesting thing I think is interesting about these guys if it works the way it looks like.
Yeah. And I could see some benefit for that because even if you're using Ramp and you have to sync transactions, and it's not a long time, but you got to wait a couple minutes till all those syncs come over and like, I'm ready, already at the next tab being like, nope, let me sync these two. And I just got to wait a little bit. And you know me with like a squirrel, then I got to do something else because I just can't sit there and wait for 30 seconds to a minute. I have to be productive and then come back and do that. So yeah, that's all native going through. That's a little bit of a feather in their cap.
Yeah. So, you know, interest to say if you want to check it out, slash.com, which also interests me because that could not have been a cheap domain to get. But, you know, they're out here at the top of their page bragging about their Series C 100 million funding at a $1.4 billion valuation. So, you know, the one thing I hate to say, but I like to see companies with money behind them because that means they might be staying around for a bit and someone is actually seeing value in this product. So if you want another option, go check it out. Jeremy, anything else to add?
Nope, not on this one.
All right. Well, then let's jump into it. A few more games real quick. I got a quick one for you.
Okay.
I mean, really quick. But I like talking about that BS. All about the balance sheet. Like, just shoot the breeze. Let's talk about some BS. Today, I want to talk about the loan zone. Because too often, loans on the balance sheet, I feel, are mistreated. And spoiler alert, if you come play UFAT with us next Friday, aka tomorrow, for those of you listening, you might get a freebie right here.
Ooh,
so,
nice.
Jeremy, 3 questions for you. Are you ready to talk about the loan zone?
Take me to the zone.
All right. Question 1. Jeremy opens his own competitor to Jamba Juice called Jeremy's Juices with his 5% investor, Beth, in a 1065 partnership. Now,
Oh, God. All right.
I, at Specialized Accounting, we're reviewing Jeremy's Juices books and see a $200K balance sitting there for years that has unchanged called a loan to Jeremy. When I ask you about it, you say, oh yeah, I needed that money to pay for my house, so I loaned it to me from the biz. Beth knows about it. Jeremy, what should we be concerned about as an accountant? $200,000 sitting there as a loan to you for several years. What's wrong?
Oh, there's a, like, first of all, I want to see a loan agreement. Is there no interest or amortization schedule that should be paying this back?
That is 100% what I was looking for.
Yeah.
It's been $200,000 for years, which means you're right. There is no interest being accrued. And this is like, I don't know, Jeremy, I see this on so many sets of books where business owners think, well, it's just a loan to so-and-so. The IRS can disallow that as a loan, saying, no, we're seeing no interest. And they can either say, if you want it to be a loan, you owe back taxes and penalties on interest for whoever wasn't paying the interest, or it needs to go as equity to someone. Well done, sir.
All right, I like it. And yeah, why? If it's a partnership, just take it as a partner draw, call it a day. Like, you're obviously not after that long paying it back or planned on paying it back.
Now, Beth wants it on the books to make sure you're going to pay it back.
That's fair.
You know, her 5% ownership. But you know what? Whatever. Jeremy and Beth, next year, they elect S Corp on their 1065. Now they're an 1120S for Jeremy's Juices. And 2 years from now, the biz is kind of struggling, so Beth puts 100K in. Jeremy books it as Beth's equity contribution. Was this handled correctly or not?
No, because it's a S Corp would have stock. And so you'd have to have some kind of like increased equity transaction of sort.
It would be. So Jeremy caught it. It's an S Corp, which means S Corps have identical economic rights for every ownership part. So if she at her 5% put in 100,000, you would have to put in 200,000. I can do math. 20 times what she did.
Yeah.
To have the same amount. So it would actually need to be a loan from Beth to the business if you want to get it in there while this is an S Corp. This is why partnerships should never be S Corps, right? Keep partnerships. S Corp should have single owners, in my opinion, always. But well done. This should be a loan with interest, as you pointed out, number 1.
Love it.
All right, last question, Jeremy, then.
Okay.
In an alternate universe, Jeremy owns Jeremy's Juices alone. This business needs some money, so he sells his Furby collection and loans 60K to the business. How should this be recorded on his books?
As long as the Furbies aren't covered in Jeremy's Juices, this is fine. Oh, God. So if I'm giving it 60K as a loan, that should be...
And you kind of answered this earlier.
Yeah, like a loan payable to owner, but then have
But you own it outright.
Yeah, but I'm a stockholder, and you're giving it to me as an individual. Or like I'm giving it to you as an individual, right?
You know, my answer here, it depends, and you're arguing both sides of it.
Oh, yeah. Okay.
I mean, yes, you're right. You could say it's a loan, due interest, but Jeremy, you're the sole owner. Why does it matter? Either way, it all goes to your tax return.
Yeah, that's true.
Might as well be a contribution rather than have the business pay interest expense and you have to record interest income.
Unless you're looking for more expenses, then you can do interest expense, right?
Yeah, but is that worth it to then do a separate tax return and pay interest income?
Yeah, right. Oh,
you're gonna have the income back over here on your personal return and pay extra. No, it's not worth it.
All right. Did I go 3 for 3 on that?
You did go 3 for 3. Well done, sir. I know.
Nice.
Yeah, the bar could not be set lower. But you know what, Jeremy? That is a one-off because it's now time for Fast Figures.
Welcome to Fast Figures. 10 questions, 1 minute-ish. All answers are numbers. The game starts now.
All right, Jeremy, we have a theme this week. I'm calling Fast Figures Frozen in Time, where every answer is going to be a year. Now, if it's an accounting question, I'm going to give you a 3-year grace window, plus or minus. If it's not accounting related, you have to get it exact.
Oh, perfect. Yeah, we're not going to have a repeat of the 100% this time.
All right. Are you ready, sir?
Let's do it.
Jeremy, the sale of home exemption for married filing joint people is $500K. What year was that established?
2005.
As part of the best days of his life, this was the year that Bryan Adams got his first real 6-string.
That would be the summer of 69.
In this year, the capital loss deduction against ordinary income was increased from $2,000 to $3,000. How long has it been that? What year was that set up? 3,000.
2022.
Bowling for Soup told us all about how Debbie is still preoccupied with this year.
1985.
You are allowed to deduct up to $2,500 in student loan interest every year. What year did that go into effect?
1990.
The Four Seasons told us all about a very special time for them in this late December back in what year?
That would also be 69.
The child tax credit increased from $1,000 to $2,000 in this year.
That was earlier. 2000.
Me and you and me, and the neon trees really should go back to this year that's calling.
1980.
The lifetime learning credit allows a 20% deduction on qualified expenses up to the first 10,000 since which year?
2016.
Prince warned us about Y2K, so instead he recommended we party like this year.
1999. Oof. Those tax ones are ridiculous.
I know, but I have a point I want to prove and I want to discuss it.
Okay,
So,
perfect.
with that said, let's run through these. So first off, Jeremy, I asked about the sale of home exemption for married filing jointly was set at $500K in this year. I forgot to write down what you said because it was so wrong. But that's all the way back to 1997. Almost 30 years ago, they set the amount at selling our homes and getting a tax deduction at $500,000. Jeremy, is it me or does it feel like we're due for an update?
Yes. I don't know what like property increased values look like in Utah, but I guarantee the last assessment I had is more than double what I paid for it in 2008 or something. So yeah, the fact that that hasn't moved at all, that's a little ridiculous.
Most inflation calculators say that because of inflation, it's about every 26 to 30 years, prices double. So, and this is honestly like a soapbox I will get on. If I run for government tomorrow, Jeremy, like fix the housing shortage you got right now. It is this. Like, make it easier for people that are sitting on their house for 30 years to sell and not get penalized to downsize and do other stuff. You open up the market. I mean, anecdotally, my aunts in Southern California, they bought their house 40 years ago for 200 grand. It's now worth 1.5, even though they want to move.
Oh yeah.
That's a heck of a bill to take versus if they would have just sold and moved every 10 years and taken the exemption every 10 years, they'd be sitting pretty.
Yeah, but moving sucks.
So true.
Yeah.
The rest of this, Jeremy, we're going to gripe about things that haven't changed in years that should have. So, question 2, Bryan Adams, the year that he got his first real six string. Yes, that was the summer of '69. Man, you're going to have that stuck in your head the rest of the day.
Yes, you are.
All right, next up. In this year, the capital loss deduction against ordinary income was increased from $2,000 to $3,000. What year? You said 2022. The correct answer, Jeremy? 1978.
Oof. Wow.
Like, most economists and CPI calculators say, like, hey, we should be able to take probably $15,500 in capital losses against our normal income if that were adjusted for inflation. We have not done squat with that since 1978, since before I was born. I think you too. No, you're old. No, before you were born too.
Yes. Thank you.
Due for a change, dude?
Yeah, due for a little bit of a change. Wow.
Anyways, I'm getting on my soapbox here. All
Okay,
right, let's
yeah.
keep rolling. Bowling for Soup told us all about how Debbie was preoccupied with this year and she hit a wall.
Never had it all.
Ian, give us that song.
1985.
Also, my son, who's a drummer, his favorite band, Bowling for Soup. Who saw that coming?
Oh yeah, nice.
Yeah, my kid's got good taste.
Yeah, dad win.
Husband's a CPA.
I know. All right, next question, Jeremy. You're allowed to deduct up to $2,500 in student loan interest. What year did that go into effect? I've started to think at this point I should give you like a 5-year plus or minus a 10-year window. Still wouldn't have helped. You said 1990. It was 2001.
Okay.
And again, adjusted for inflation, this is a number that should have nearly doubled as well. $2,500 is all you can get for student loan interest deductions.
They should mark that to like what the average student tuition rate is, because that's what, like tripled in the last 10 years or something.
Dude, again, I'm sitting here, I'm ready to run for office. Just let's index all these things and we solve half our problems, man.
Right. And as much as I would vote against you, but would really be interested in what your slogans would be, because that would be fantastic. But like, yeah, if you are trying to tout yourself as the like education forward country, how do you not change this when you see this? And then like all these universities have trillions of dollars of endowments and things out there, and you're going after that. Like maybe just help the students out a little bit, and then they could pay. Yeah. Anyway, I'm soapboxing with you now. I'm done.
Things that need to move. All right, the Four Seasons told us about a very special time for them back in December of this year. Ian, hit us with the song.
What a lady, what a night.
You said 69, late December back in 63. What a very special time for me. Yeah, me doesn't rhyme with 9.
It doesn't. Oh,
Yeah.
okay.
I
Dang,
know.
I thought I was
Sorry.
going to get all the songs right. I was going to pull out.
I thought you were too.
Dang.
Oh, well. Child tax credit increased from 1K to 2K in this year. This is one of the few things we're keeping up on. Well,
That was wrong.
Oh, yeah, that was wrong. Sorry.
Mine for sure was wrong. I did not say whatever this is.
You said 2018, actually. TCJA did that back in 2018. So, all right, I'm not going to complain there. I was just running out of fodder for things that haven't changed.
Yeah.
I know.
Yep.
But me and you and me, we should go back to this year that's calling. Ian, hit us with the song.
Let's go back.
You said 1980
1983.
is calling.
Yeah.
I know.
The
I'm
threes.
sorry.
Dang.
I thought for sure you'd have it. Jeremy, next up, the lifetime learning credit allows a 20% credit on qualified expenses up to the first 10K. How long has that been in effect? It's been in effect since 1997. Again, like we're talking about education stuff, man, getting the interest loan deduction, getting the lifelong learning credit, all those things, that should be doubling up again at least. So there you go. There's my political platform for you.
Yeah. Again, market to tuition inflation, right? Like, yeah, I don't know.
Yeah, we just helped solve half of student loan debt and the housing crisis. You and I, right here, man.
Right. Yeah.
Yeah.
And Otto for Senate.
I don't know about that.
All right, fine.
Yeah. Ain't got no facts. We're just talking tax. I don't know. I got nothing. All right. And last up, alternative facts, right? Wasn't that a thing for a while? I've got those.
Yeah.
Alternative facts and ideas with tax. All right. Prince warned us about Y2K. So instead, he wanted us to party like this year. Ian, give us some tunes.
Tonight I'm gonna party like it's
1999. Jeremy, if you take nothing else away, we need to start adjusting some things. If you ever have sway when you get voted onto NASBA's board or whatever else, just making my ploy out here.
Yeah. Let's get some proactive change in the world, right? Yep.
Yeah. 4 out of 10. Well done, sir.
Nice.
And with that, we're ready for winner of the week.
All right, so winner of the week, again, CPAs, or maybe even aspiring CPAs, because I know one of those. Both Missouri just passed the bill that approves the a little bit lower bar for sitting for the CPA exam, where you can have a bachelor's and 2 years of experience to sit for the exam. All right, we've talked about this one before, but just passed in Missouri. And then also our friends in D.C., which seem to be getting a lot of airtime on today's episode. They just started a bill that passed the council recently with the same goal of lowering that bar or changing the bar a little bit, creating that other option for CPAs for the exam. So cool. That's that one.
It almost needs to be its own trivia question of who now is not on board. Like who we should start like having a betting pool on who's going to be the laggard, the last one to cross the line.
Yeah, the last one to do this. Yeah.
Go banana.
Right. All right, and then loser of the week, Shakira. She may have dazzled at the World Cup halftime show.
She was great.
She was great, and I was pretty excited to see Spain walk away with that. But Spain not being the nicest to her. So back in May, they dropped their suit for potential back taxes for it, but now the Spanish Supreme Court has appealed it and taking this again. Right. And also it is very important wherever and whenever you are, because they're going back and looking at both like her credit card receipts, salon appointments, and things like that, trying to prove that she was there for 183 days, which would require her to pay this tax, where she's committing that she was only there for 160 some odd days during the year. So yeah, that's I think it's like a $60 million thing, or 14 million euros or something thereafter. It's crazy.
I do not envy our friends over at like Anchor who are counting their days, you know, like, oh, okay, I'm already sitting at 150 and I got this coming up. And it's like, man, they are budgeting their days like crazy. I am so glad we don't have to deal with that.
Yeah, and I wonder if when they're home or whatever, they go do a credit card transaction somewhere just to be sure. As be like, nope, I was here. There's the proof.
I bought a Jamba Juice or a Jeremy's Juice. I can prove it.
That's right. Love it.
All right. Well, Jeremy, that's all we got for this week. Time to make like a check and clear. Catch you later.
Let's be honest, most of us didn't become bookkeepers or accountants to spend hours learning marketing systems and chasing leads. Heck, some of us became accountants because we didn't want to talk to people. We did it also to serve clients and build businesses we love. But what if you could get better clients without the marketing overwhelm? Well, that's exactly what Keepful does. It's an all-in-one marketing system built specifically for bookkeepers and accountants. And it works 24/7 behind the scenes to bring in leads, book consultations, and automate follow-ups. You get a professional website, branded consultation page, and follow-up automations all tailored to your business. No more duct taping tools together or hiring expensive marketing teams. If you want to grow your firm with ease and attract better clients without doing more work, go check out Keepful today at keepful.com or follow the link in the show notes to give us a little bit of extra credit with the folks over at Keepful.